All right, guys, we're going to do Target right now. They have fallen a lot as of late. In the last 6 months, they're down 18%. In the last year, 15%. But they're still up over the last 5 and 10 years. Now, guys, full disclosure, I own a position in Target. Mo, do you?
No, I don't.
Do not buy Target just because I own it. This channel is created to teach a process. And what works for me might not work for you. My investing goals are different than yours. My price might be higher than yours. It's routine that Mo, a good friend of ours, and myself, we do our analysis, and my price ends up being higher than both of theirs. Our desires are different. Our goals are different. We're here to teach a process. So if you're here to learn how to become a better investor, we are absolutely the channel for you. If you're just here to get a stock that this guy owns so you can mimic it, we're not the channel for you. Go follow one of those other YouTube channels that will help you lose 80 or 90% of your money. We're here to teach a process that can be applied to every sort of investment in the world. All right. So we're going to go over Target, some bull and bear cases, some news, etc. We're going to go through our 8-pillar process. We're going to use our stock analyzer tool to determine what price to pay based on our assumptions about the future. And guys, we're going to have something here for the beginner investor and the more advanced investor. So stay all the way through to the video. There'll be something in here for everybody. If you're just beginning your journey, this is a great place to start. It'll be overwhelming, but I trust me, it'll get better. So Target, all-time high, $268.98 just in November of 2021, Mo. Less than 2 years ago, it was at $268. It's now at $134. And the low was $125 just about a month ago.
Wow.
Yeah. So if I told you, if we'd made a video back here, by the way, did we make a video? When was the last time we made a video on Target? Guys, can you find that out for us?
May 7th.
No, before then. Was there a video back in 2021? Let's try to find out because I want to see what we were saying because one of the most common comments we get is that stock will never fall that much because it's hard to imagine. But then all of a sudden, the woke police attack and all of a sudden, stocks can fall in half. And that's exactly where it's at today. Half of where it was just a year and 9 months ago. Okay? Just remember that. Every time you think it can't happen, it does. Now, Target's market cap is $62 billion. That's all the shares outstanding. If you were to buy them all in the market, it would cost you $62 billion to own every single share. But their enterprise value is $100 billion. The enterprise value is essentially buying all the shares plus all the debt and then getting a credit for all the cash. So this difference right here of $38 billion is essentially their net debt. But guess what, guys? They got a lot of leases. So I'm not at all worried about this one bit because I'm sure their debt's going to look very high, but it's a lot of leases. Now, their PE is 18, their 5-year PE is 15, and their overall profit margin is down versus the last 5 years. Okay?
Yeah.
Right? Yeah. Now, their gross margin is 25%. What's Walmart's gross margin, Mo? 24.1. So they're right in line with each other. But Target's kind of considered the
higher end
of the. I like going to Target. Mo does not personally. I like it. They got a Starbucks inside. I don't go to Starbucks, but my wife does. So, or my fiance, whatever you want to call her.
Thing.
So Mo, can you look up something for me while I'm doing some videos? Can you look at their 10K and tell us how many stores they're opening and closing on any given year?
Sure.
So guys, let's pull up the income statement just to look real quick at their revenue growth. This is going back 10 years, 71, 73, 71, 71, 74, 76, 85, 100, 108, 115. Big jumps here in COVID year. Big jumps. Big jumps. So take that for what you will. The profit has pretty much been the same though. Well, no, they had a big jump. So guys, look at this. We've always explained to people that big jumps from temporary problems, just like big drops from temporary problems, should stabilize. They went from 3.5 billion to 6.3, down to 4.2, down to 3.4. Okay? That's something that you have to remember, that when there are temporary things in the market that happen, like COVID, that can affect profit on the low and high side, here it helped Target out. All right? Let's go look at the 8 pillars here on the company. Now remember, guys, if you have our software, you can customize your 8 pillars. You can actually make it up to 12 pillars, and there's like 4 quadrillion different variations. But apart from, it's a 7-pillar stock, and look, the debt is the issue. It's about 5.5 times their long-term free cash flow. Okay, so that's a little bit higher than we like, but it's not far off. Remember, they have a lot of leases. Everything else is a check mark.
You're going to see a lot of that in retail.
100%. So Mo, what'd you find out about opening and closing?
So they opened 23 new stores, closed one, total of 1,948.
So a little over 1% growth in stores. So really, when you look at their revenue growth, it's pretty much organic revenue growth.
Yep.
Right? Because a lot of retail will try to open more stores as a way of showing a lot of revenue growth. But when you're this large, you have 2,000 stores and you're opening 23 in a year, net 22. Okay, you're getting 1% revenue growth that way, but overall, it's still going to be driven by the organic sales. Go ahead, Mo.
Talking about revenue growth, if you pull up the income statement, they went from 71 billion of revenue in 2014 to 73 and a half to 71 to 70 to 74 to 76. I'll call it 77. Then 84, 100, 107, 114.
Yeah.
What's your thoughts on that?
We talked about it already. I know you were focused on the 10K.
At something else, sorry.
It is concerning to see this.
Yeah.
However, the interesting part is the thing that concerns me more is revenue's gone up and profit's gone down.
Oh, okay.
That's what's more concerning to me.
Glad I asked because I did miss that part.
That's the part that's a little bit more concerning to me. Okay. How is revenue up so much and profits down?
Right.
Is it higher SG&A expenses? I mean, it has been higher, but it hasn't jumped up a ton. And their gross profit is, interesting. And guys, soon in our software, we're going to have a button that allows you to press it to show you the percentages. That way you can see the percentages as a percentage of revenue on all these metrics and see how that's changed over time. It's gonna be a great way because obviously when revenue is 70 billion and you see 21 here, it's hard to really compare this way. You have to go, okay, you have to pull your calculator out. We're trying to eliminate as much work as possible for you. So you'll be able to hit the percentage button and allows you to go, oh, this went from blah, blah, blah percent to blah, blah, blah percent. That's why.
They bought back a lot of shares in the last decade.
Well, in the last 5 years, they bought back 15%. What did they bought back in the last decade?
170.
Oh, wow.
170 million.
Wow.
Yeah.
That's almost 30%. That's like 26% in the last decade.
That's a big number.
But the question is, Mo, we don't want them buying back expensive shares.
And I think that's probably what they were doing here up until
because the stock's in half. And look at the PE still.
Yeah.
Okay. What's the return on invested capital? Hey, pretty good. 14.4%.
Oh, okay.
In the last 5 years.
Oh, I was looking at the 10.4%. That's
okay.
Last year. All right.
So, Mo, can you go over some, do you have any information on them? Or should we just go to analyst estimates?
Let's just go to analyst estimates. The one thing I do want to point out,
though,
holy moly.
Guys. Okay. Big jumps in profit. $5.60.
This seems a little.
To $15.65 in the next 4 or 5 years.
See, I
that makes it a 9 PE right now for 5 years from now.
The revenue's more reasonable.
So maybe analysts are sitting there saying, listen, this is a temporary issue why their profit's lower. Okay. Now, again, I think you'll see in the stock analyzer tool why I'm still a fan of Target right now, but I want to show you these things. And the other thing is, interesting, very, very interesting. Okay. So let's go to the stock analyzer tool. Again, guys, this is the most popular part of our website. It's part of our long list of tools: retirement calculator, stock analyzer, analyst estimates, all these things, including real estate calculator. Guys, we are running a special. Oh, and our community. Thousands of investors in here. People are talking about Target. You can look up TGT or Target and go right to the chat where people are discussing it. All this is available, running a special right now, $10 off per month. Right now, through the end of the month, it's $10 off per month if you sign up. And on top of that, you get Real Estate Calculator in there. Once Real Estate Calculator is officially tested and done, it'll become its own separate unit you have to pay extra for. But if you sign up now, you get this for life, forever, as part of your monthly fee. So sign up now on everythingmoney.com. $29 per month is the discount from our normal price of $39. So come check it out. So Mo, you want to run some stock analyzer? What are you thinking about? I see that face of yours.
I'm just trying to figure out where the revenue is going to go. I was thinking about putting in there 3.5, 4.5, and 5.5, but my question was, is that too narrow?
Okay, so let's do this 10-year analysis. You can do up to 20.
Because I almost think if I go 2.5, I think that's too low. If I start going 2,
and the reason
3.5, 5.5, 7.5, I think 7.5 is too high. So I'm kind of.
Well, but wait a second. What if inflation is 4 or 5% and they have 1% growth in their stores every year?
It's true.
So I don't think, and plus the other thing is 7.5 is a good, guys, we like doing a really, really high assumption and a really low assumption because it kind of tells you, let's say, for example, the really high assumptions make the stock price $100. Then you're like, oh, at 134, this is just ridiculous. So Mo, I actually do agree with you.
Okay.
Let's do.
It's 7.5 is like high, but achievable. just everything has to go well.
So at 3.5%, Mo, and they're growing 1% of stores, it really means that overall prices just go up 2.5% a year.
Right.
That's the Fed's goal for inflation, essentially, right?
Yeah.
And at 7.5%, and they're growing the stores by 1%, you're at 6.5%. Well, what if we have more inflation because we printed a ton of money and inflation is 5 or 6%? And all of a sudden you're in line there.
Right.
All right. Now what about profit margin? We've seen 3.6% on average over the last 10 years, 4.3 over the last 5 because of COVID.
Right.
Same with free cash flow. So, but in the last year or so, what are you thinking here, Mo?
2.5, 3.25, 4.
Okay.
What do you think?
I think that's fine. I might have done 2.5, 3.5, 4.5.
Okay.
Because I do think, like Mo, look at this. Their free cash flow is going to be way higher than. I mean, they've never had. I mean, look at this free cash flow. I think we're too low on free cash flow. So let's do this. Let's do 2.5, 3.5, and 4.5 on their
everything
on their profit margin. And for free cash flow, I say we do 3, 4, and 5.
Okay.
Guys, and remember, when you're putting these numbers in, it's important to compare and say, okay, how would the business be different in the next 10 years versus the last 10 years? The next 5 years or the last 5 years? That's why we put these numbers in here. It's important for you to understand these. And I go, okay, well, the last 10 years included COVID, but I love the fact their free cash flow is actually higher than their profit margin. Usually it's the other way around. You're like, oh, why are they reporting more earnings than cash flow? Earnings are much easier to basically cheat about, to manipulate, but their free cash flow. Now, the other thing is, Mo, what's Target been complaining about lately? A lot of theft. A lot of retailers are complaining about theft.
So many videos out there.
And you know what? That's going to change. That's not going to last forever.
No.
They're going to figure out a way to handle that. So I think that's probably been a part of the reason. I think I read it was like $500 million. They said was lost from theft. And that $500 million, you don't sit there and go, oh, that's a small amount. Guys, that's a big number. When the company makes $3.5 billion in a year, $500 million is a big chunk of money.
Yeah.
Big chunk. Oh yeah, look at that.
Yep. 500 million.
$500 million more than the previous year. All right. Now PE, Mo, and price to free cash flow.
I was thinking 15, 17, and 19.
So guys, the important part here to understand is the market average is 15. So you should go higher based on a high return on invested capital, which is right here, because this basically says, hey, as a company, Target is really good about reinvesting money in its business and getting a high rate of return. And you should want to pay more for a company that can get higher rates of return. And the growth rate isn't great, but I think this high rate of return over the last 5 and 10 years on the money that's in the business is a justification for a higher price. And Target has a great brand. Target is not competing with Walmart. It's a totally different demographic.
It is.
It's,
I wonder what the average income of a Target shopper is.
That's a great thing to look at. So guys, a lot of times a 10K will tell you who their target audience is. They'll say, here are the demographics of our target audience. So we're going to look it up right here. And this is what we do. We're trying to look this up. Typical Target shopper is a millennial mom, $80,000 in home income. Now let's look up who's 39 years old. Now let's look up Walmart. 59 and a half years old. Oh,
same number.
Interesting.
White female, 80,000.
But age difference. Look at the age difference. Walmart,
Yes.
59 and a half. Target was 39.
Right.
I'm surprised about the income part.
Me too.
Very interesting. So look at it, guys. We learn these things all the time. And that's part. Remember, you don't want to do deep dives until the stock is selling for a price that you think, okay, now I need to go spend more time on this. Now, Mo, your desired annual return. Guys, this is your margin of safety. The higher your assumptions, the more return you need. That's how you give yourself more margin of safety. If this cell phone's $1,000, you're make a higher return if it's $100 versus $900. It's very logical in that sense. The more money you pay for something, the less return you get. So Mo.
I say 10, 12, and 14.
I love it.
Yeah.
Now, guys, I consider intrinsic value to be 10%. Intrinsic value is what am I willing to pay? What is what do I think the company is worth by itself in a normalized market? And the reason we put 10% here is we already beat this up pretty bad here, we feel. So there's no reason to make a huge return on this. But as we made higher returns, higher assumptions, we need a higher return. Now, guys, we're going to hit the analyze button. You need to stay in this video through the very end because we're going to explain these numbers and we're going to explain other ways in which the software is used to help you make better decisions based on those numbers. So please stay with me throughout the entire video. All right, I've hit the analyze button. Oh, wow. Okay. low price of 90 to 110, a high price of 195 to 215, and middle price of 140 to 160. So guys, if you paid today's price, your current return would be about 7.25% if all of our low assumptions occur. It'd be 14.5% if our middle assumptions occur, and 21% if our high assumptions occur. So you have a decision to make. What are you doing here? I'm going to add Target to my watch list, even though I already own shares, at 130. That way the software will notify me and I can go make a decision from there. But guys, this company, in my opinion, if you're interested, go do more research and make sure you love it. This is a very low price. Could it still happen? Absolutely. But if you understand why you're buying it, you're going to add along the way. You're going to keep adding shares along the way. And it just shows you how high the price of 260 was back in the day. Now, granted, this is a very high return, Mo.
Right. Let's put in 10.
Well, let's put in 10 to see what the intrinsic value was at each level. Yeah, it was about there.
Yeah, it was there.
But again, it was making the highest assumptions and only making 10%. That's why we have margin of safety. So guys, again, if you like our software, if you like our videos, we want you to do one of two things. We want you to subscribe to our channel and also go to everythingmoney.com. We're running the special, $29, $10 off per month. Sign up today. Thank you very much for your time.